This meeting is being recorded.
Hi, Joe. Good morning.
Good morning. You okay?
Yeah, I'm good. I'm all good. Um,
Okay, awesome.
yeah.
Well, we got some people here already, so I'll start letting people in. Did you see my agenda?
Yeah. Yeah, that
That,
makes sense. Yeah, introduction, and then you can give a little overview of the process, and then
yeah,
you can launch into more of the tax specific concepts, right?
beautiful.
Yeah, that'll be perfect.
All right, okay. Have fun.
Oh, no, it'll be good. It'll be good. Yeah, I'll just give a little intro on myself. Once.
Yeah. I'm gonna share some of that about as well. So,
Sure.
all right. Let me just let the gang all in.
My 17 years is probably more like 20 now. So.
Okay.
uh, that's how fast time goes. I think I gave you that 2 years ago when we.
Oh yeah, okay. So thank you for correcting that. You
Yeah.
got more expertise now. Yeah, I'm excited. So we've got some people here already. Um, if you're joining, please feel free to say hello. Well, maybe let's see here.
Everybody can connect to their audio and stuff.
Yeah, that's right. May take a minute.
Depends if they're Zoom savvy or not.
Yeah. Well, this is here. So are they having a problem hearing me? Can anybody hear me?
Hello, Joseph. I can hear you.
Okay. A voice from the dark. Who's there?
This is Jacques.
Say that again.
This is Jacques Pelletier.
Jacques Peltier. Okay, welcome, Jacques.
Hi,
Um,
Chuck.
has anybody else joined that would like to say hello? You don't have to come on camera, but if you'd like to, you're welcome.
Hi, Joe. I'm here. Ryan.
Hey, Ryan.
Ryan, hey, man, see you.
Good to see you. Thanks for the invite.
Say what?
Thank you for the invite.
Okay, yeah. We'll wait a couple more minutes till there's Alyssa joined us. And welcome, Alyssa.
Hey, Alyssa. Been a while. Nice to
Hey,
see
yeah,
you.
it has. Nice to see
Yeah.
both of you again.
Yes.
I saw your name come up and I thought, well, I want to hear from Jonathan.
Yeah.
Right?
Yeah.
Okay, you mean it wasn't me that you were coming to see? Jeez.
Yeah. Life moves too fast, Alyssa. It's just, it's crazy.
It really does. I try and slow it down every summer, but never seems to work.
No.
Okay. Let's see. A couple more people here. Okay, Dan Fogarty from the Credence Clearwater. Actually, that was John Fogarty.
Yes.
Okay, so Carly's joined us.
Carly. Hey, Carly.
Hi, good morning.
Good morning.
How's everybody? How are you feeling, Carly?
Great. Thank
Yeah.
you.
Yeah. Okay.
Great.
Oh, there she
How are
is.
you doing?
I'm good.
Good.
You're in your cozy kitchen, I can see.
I am. That's the way I work.
That's great.
Yep.
That's great.
Talk about houses all day long and
Yeah, you do. Um, let's see who. Why don't we give a couple more minutes before we start? Just as I know people tend to pop in a little bit late, and we'll just then begin with the introductions, if that's okay. 2 more minutes. Is that okay for everybody? Just talk amongst yourselves if you.
No problem.
Oh, what can we talk? You talk about the weather? I guess that's changed. Has been a little bit chilly the last couple of days. I put my jacket on.
Yeah, I'm ready for summer to come back.
Yeah, come back.
Yeah, I thought it was going to be today, but it looks like it's trying.
Okay. All right. Well, yeah, it didn't hurt to get a little watering when it's been hot for a while.
Yeah, that's right.
Yeah. Okay. Hear a knock at the door. Let's see. Yes, Brian is joining. Brian, you're here?
Yeah, I'm here.
Okay, well, welcome. I'm just trying to see, trying to do something here. As an experiment. I'm not sure if it's going to happen, but we'll try anyways. Okay, I think we're pretty much ready to go. Jonathan, do you have any questions or thoughts before we start?
No, we should start, and if anyone else knocks on
Joins?
you can just let them in as we go.
Yeah, okay, I'll do that. Okay, so you may see my eyes moving back and forth. I'm managing a couple of screens here, so not to worry, but we're gonna we're gonna basically get into it. And I'd just like to first of all welcome everybody to the event. Today we're gonna share tips and strategies for business owners and learn more tools and techniques for, protecting your assets, that is your business, and maximizing your sale proceeds. Today we have expert tax planner, tax partner, Jonathan Osten from PwC. Thank you, Jonathan, for joining.
Thanks, Joe.
Jonathan does specialize in the private company area, so he's working with business owners, and he has accountability for the BC region for PwC. I'll tell you a little bit about Jonathan. Will explain a little bit more about himself and where he brings his practice to add value in this exit planning process. But I am a certified business exit planner, and I founded my own business in 1994 called Solly's Bakery here in Vancouver, and had my own exit experience from that business 16 years later. After a variety of different pursuits in terms of in terms of business coaching, I found exit planning, and I was really engaged in the whole practice because I really thought that it solved a problem that business advisors were not addressing. That is, the owner's exit, and ultimately what that looks like and how that should be done in a coordinated way. So I help business owners with businesses that are valued in the $5 to $20 million range, kind of map out their strategy in about 90 days before they become burnt out or health problems arise. So they have enough money, to live the lifestyle that they want, and also an invigorated sense of purpose about their life after business. And so for today, I'm bringing Jonathan on because Jonathan really specializes in a particular area of exit planning, and that is with the tax mitigation. So I'm just going to share a little bit about Jonathan. he and I had talked about questions that owners or their advisors are asking when an owner is thinking about leaving their business. And so together we put together a number of questions that we thought would be valuable because it's the type of questions that they get asked. So I'm going to ask some questions, but I'm also going to open it to your questions. In other words, if you want to ask something, you can either put up your hand on the screen, or you can put in the text or the chat message, I should say. And if we don't get to it today, then we'll certainly respond in email. Jonathan, is there anything you want to add to that?
No, thanks so much, Joe. Yeah, no, it's great to be able to meet some of you today and just sort of share some insights. Again, yeah, my practice is primarily all private company work at PwC, and I'd say the majority of my accounts are family owned or involve fairly tight shareholder groups, right? So we try and not only deal with the corporate tax landscape, but we also look at the owners or the ownership group and try and sort of bring it all together and understand what their objectives are as it pertains to their business and their overall wealth. And certainly as they look to exit a particular business, we like to be front and center with that objective and try and get involved and add value wherever we can. And being able to collaborate and share insights with someone like Joe, who specializes in facilitating the exit process for a business owner, is really important because sometimes we just don't have the capacity as tax advisors to deal with all of the non-tax implications of an exit, the emotional issues associated with it, just some of the softer matters that go into the process, right? And to be able to work with someone like Joe and other specialists, on the legal side or the insurance side or the corporate finance side in the process is really, really valuable. So yeah, today we're gonna dive a little deeper into sort of the tax issues that the business owners typically ask, or Joe for that matter, as the exit planning facilitator would ask, and try and give you guys some things to think about. So yeah, please raise your hand or type in a question as we go, and we'll address it in real time if we can.
So I thought we'd start by just explaining to people that are joining us here today, and that what is exit planning, and what are the roles of the advisors, and then get into specifically your role at the table and what you bring, what value add, and what skill sets you bring that are really necessary to the successful transition of an owner. So I'm just going to share this screen here. I'm hoping everybody can see that because I can't tell what you're seeing at the moment.
Yep, we can see.
Are you seeing what is exit planning? Is that?
Yes.
Okay. So yeah, it's really about making a plan to leave your business. To get the value and out of your investment, the years you've put into your business, where you feel, I think owners want to feel where they've left their business and they got a real sense of return for the effort and energy they put into it, maybe more than they thought. But that's really the mark of an exit plan, is to really look at what the end process is, what's the outcome that the owner is going to have, not only just at the time of exit, but beyond that in the years that they have to spend outside their business. So when we talk about exit planning, we talk about objectives. We talk about when do they want to leave. We talk about how much money do they think they're going to need. We figure all that out, and who will they sell their business to? And then we look at kind of the advisor team, right? So when we talk about exit planning, it is like building a house in many ways. In other words, you have a number of different tradespeople with expertise in one area or the other, and they come together to complete a project, and such is the case in exit planning because it's a team effort. It's a collaborative team effort of a diverse group of advisors that work, again, collaboratively to help the owner achieve their goals. So when you follow that process of, first of all, getting clear what your objectives are as an owner, what that outcome will look like for you. And once you document that and map out a strategy, then you can engage with the other advisors that you need to be at the table with you as you implement your strategy and plan. And so you need that exit map, if you will, so that as the other advisors come on board, they really know what we're all trying to accomplish, and they also know what their role is. Each advisor at the table brings a specific value to the exit planning process, and ultimately the process is what becomes the outcome. So when you're looking at a roadmap for the whole process, not just kind of strategy mapping, but advisor team assembly of the right team of experts, like a sports team or like a band, where everybody knows their part and they're expert at what they do. So I always say, like, don't get the lawyer that did your divorce to manage this part of the transaction. But you need someone who does this every day. That's their business, is looking after owner transitions. And Jonathan has a significant amount of expertise in that area. And so I just kind of move on, I guess, really to the questions that I had. And yeah, Jonathan, so let's talk about that for a second. So tell me, what is your role in the exit planning process as a tax advisor?
Thanks, Joe. Yeah, no, it's a privilege to be able to sort of be part of this process with a business owner, whether it's an owner that we've known for a number of years and we've looked after, or in many cases we're brought in, specifically to assist in this process, whether it's by you, Joe, or some other sort of advisor that's got a deeper relationship with the client or the business owner. And we come in and we try and start off by really leveraging on what's already been conveyed or learned as far as the client's goals and objectives.
Right.
We really take our time to ask a lot of questions and get enough of an understanding on where they are, what they hope to accomplish, because any sort of tax idea or tax structure is predicated on what those goals and objectives are. We really try to not race to a solution too quickly without asking enough questions and satisfying ourselves that we know what's most important. Because sometimes simple is best, right? It's not all about creating a complicated structure that's going to take time, and it's about trying to get to the most practical, useful solution, right? So we spend that time up front, and we get to know the players that are already involved, and start from there ultimately.
Right. So when's the right time to get an advisor like you on board? I mean, exit planning, the whole process from beginning to end can take years. So when do we need to be talking with you?
Great question. I mean, this is probably the most important thing to take away from this whole conversation is tax advice and the role of the tax advisor as early as possible. It really is important that the sooner a competent tax advisor can be part of this exit process, the better. And I know practically that isn't always the case. Sometimes we get brought in later in the process. But
Right.
yeah, I mean, to give us an opportunity to advise on the best structure and the best outcome, both from tax minimization, potentially tax deferral,
Mm-hmm.
the earlier the better, because a lot of structures and a lot of rules within the Income Tax Act that pertain to this process require lead time.
Right. You
And
won't be, otherwise you're not eligible, right?
that's right. You can
Right,
fall
I
off. You can fall offside of a number
Right.
of tests, right?
Yeah.
We'll give
Yeah.
some examples in a little bit, but
Okay.
it really is important, right? And if we're brought in too late, then, we can be handcuffed in terms of what we're able to do, or we're just sort of reacting as
Like
opposed
a minimum 2 years, on 2 or 3 years. I mean,
Ideally, yes, yes. A lot of tests require a 2 to 3 year sort of, period to lapse before, to allow certain tests to be met, right?
right,
And the CRA statute of limitations is 3 years in terms of, sometimes transactions being implemented where the CRA can still go back and audit a filing position, right? So
right.
yeah,
And
2 to 3 years is
also,
ideal.
I mean, there also, I'm just thinking here a little bit as well. One of the first steps in the exit planning process is kind of getting a feel for what the business might be worth.
Right.
So, I mean, if they're going to live a lifestyle after the business that they want and they need this amount of money out of it, they need to know what the business is worth right now. And where do you participate there?
Yeah, I mean, from a tax perspective, in terms of, valuations and being part of that, I mean, a lot of transactions that we implement for tax purposes are achieved on a tax deferred basis. We're fortunate that, the Income Tax Act has a number of provisions that allow for tax deferred transactions. And,
When
often,
you say that, sorry, when you say tax deferred, you mean like they're going to pay tax, but later.
yeah, yeah, whatever we implement, sometimes requires transactions to be reported in the owner's tax return or the company's tax return, in the moment that we implement. But
Right.
there should be no gain or loss, realized on those transactions to the extent that there's value inherent, of course, in the business or in particular assets within the business. The transactions that we implement now, the tax on that should be deferred to some future date,
Right.
provided that we're on side. But often, we need to value those assets or value the business,
Right.
right? So in terms of valuations, like we don't do valuations as a tax practice, but we work with our valuations
Value.
colleagues either internally at PwC or externally if the client has another relationship, and try and sort of figure out what level of valuation is required. It'll obviously help the owner understand what his or her business is worth or asset is worth,
Right.
but we also need it for certain transactions that we're trying to implement today to help with the eventual outcome.
So when you mentioned assets and that, and you can sell the assets of a business or you could sell the shares of the business,
Yeah.
why is that important to figure out for tax purposes?
Just before I address that question, Joe, I just want to elaborate on my last point. So for example, something that we might do today, to prepare for the future is, often you'll see that, a client's business will have real estate assets in it, in addition to the active business.
Right.
And sometimes, there'll be a desire to separate the real estate from the active business in advance of a sale down the road because, the business owner may only want to sell their business and not sell their real estate that goes along with it. So in order to move real estate out of an active business to a real estate company, not only requires that lead time I talked to you, but we've got to value that real estate, and that sometimes will give the owner an idea of what what they're looking at in terms of future value. So that's
Well,
just
one question I just thought when you
Yeah.
mentioned real estate, we live in Vancouver here.
Yes.
So,
Yeah.
the cost of real estate here, I mean, does it make any sense for an owner to sell their real estate with their business or?
I think it really depends, right? I mean, we encourage owners to look at their asset classes separately, right? Like they've
Yeah.
got their operating business as one
Right.
asset class, they've got their real estate assets as another asset class.
Right.
A lot of them have, markets investments as a third asset class. And, often the real estate asset is used in the active business, right? So it really is a comprehensive discussion that we would have, that you would have, Joe, if you're working with the owner, whoever that trusted advisor is, as far as what is their goal and objective for the business and what is their goal and objective for their real estate, right? And there's no one size fits all answer, but we need to understand that objective again, so we can say, okay, does it make sense for the real estate and the active business to be kept together? or do we need to separate them to allow for flexibility down the road when the time comes?
Right. I think someone's got their mic on, and just hearing some background noise there. Thank you for just mute everybody unless you have something you want to ask or say. And again, feel free to put your hand up or put your questions in the chat, and we'll address them, or we'll now or later. It just there's a speaking of tax and capital gains and all this thing, that people have concerns that there's some recent changes in capital gains. Can you explain a little bit more about the lifetime capital gains exemption?
Do you want me to talk about the sale of shares versus assets first? Just
Yeah,
before we get in,
yeah.
because that's a really important question you asked. So why don't I address that, and then we'll get into the capital gains exemption, which is ever changing, and we need to make sure everybody's kind of up to speed on where that's at. But as far as sale of shares versus assets go, I mean, I'm sure a number of the folks on this call are familiar with that concept, or have come across that in their practice or in their day to day at one point or another. But yes, it is really important that as a tax advisor we understand up front, in the process of gathering background, asking about goals and objectives, reminding an owner or owners that, as a vendor, generally speaking, if you can negotiate a deal to sell your shares of your business, you often will end up in a better tax result than if you negotiate a deal to sell assets. Things have changed in the last month with the capital gains tax rate changes, but still, generally speaking, it is advantageous to try and negotiate a share sale versus an asset sale, and a lot of that is due to the lifetime capital gains exemption that we'll talk about in a few minutes.
I see.
The problem is that most of the situations that I see is when an owner is looking to sell their business, often the buyers that they're talking to or negotiating with are keen to buy assets and not buy shares, right? Because it's you're not inheriting the history of the company when you buy assets. You can get a better sort of depreciable tax base if you buy assets, and you don't have your costs tied up in the shares that isn't going to yield an immediate tax benefit as a purchaser, right? So, we need to explain these concepts to our clients that are looking to sell, and they just need to be aware of what the general bias of a purchaser is going to be versus what their bias as a seller is likely to be. And ultimately, we see it being a negotiation sort of tool, right? Because buyers and their advisors know if it becomes a share deal, the owner's going to get tax benefit in all likelihood. And sometimes the sale price is negotiated down as a result, right? Likewise, if it's inevitable that you're dealing with a purchaser who just won't buy your company and only wants to buy your assets and maybe your goodwill, it's a way to negotiate the purchase price up, because when all is said and done, you as a vendor will be subject to more tax on that exit.
So buyers, want to buy assets, and sellers want to sell shares. And so
generally speaking, yes, that is fair to say, right? There's always specific nuances that can throw that off, but yes, there is. We have an M&A tax group at PwC that gets into more detail than I do.
Yeah.
If the deal is large enough, a share sale can really result in a preferential sort of preferential outcome from a tax perspective for vendors, even with the increase to the capital gains tax rate as of a month or so ago. So yeah, a sale of shares, if there's enough lead time and collaboration with tax, can usually yield the best answer. So that's something, depending on the circumstances, we get our M&A tax team involved early to sort of vet what possibilities there may be. Right.
Yeah. And so do you want to extend onto the lifetime capital gains?
Yeah, it's a perfect segue, because again, the reason why vendors typically prefer to sell shares, especially in the market you deal with, Joe, that $5 to $20 million company range, is because of the lifetime capital gains exemption and the tax savings that measure gives rise to, right? And since I've been practicing tax over the last 20 years, I mean, that lifetime capital gains exemption per individual has steadily grown.
Yeah.
It's been indexed to inflation over the past number of years. At the end of 2023, it was over $900,000 per person, and then with the 2024 federal budget that just came in a few months ago, the lifetime gains exemption is now up to 1.25 million per person, right? So it's, for all the frustrating sort of measures our federal government has implemented on the tax front for private companies, this is one of the things they've done well, in my mind. Like they're continuing to promote, I guess, entrepreneurship from this perspective, even though some of their other measures are counterintuitive. But the lifetime gains exemption keeps growing, and if you've got certain family dynamics, like if you've got a spouse and some children, perhaps even some adult parents, and if we structure things strategically, you can multiply that capital gains exemption amongst more family members, and you can really shelter tax on this deal, right?
So everybody in the family gets 1.25?
Yeah, in their lifetime, right? I mean, I know there's at least one or two lawyers on this call, and there's some non-tax challenges to multiplying the lifetime capital gains exemption, especially when you use a family trust. Do that. It's one thing to sort of sell the shares held by the trust and then allocate 1.25 million of gains to multiple family members. It works great on paper, but the realities of that now today are that those beneficiaries, especially if they're non-active beneficiaries, they in theory need to receive that money, right? They're entitled to it legally from a trust law perspective, and if that money doesn't make its way out of the system to them, you can run afoul if the CRA gets wind of it, and it can be attributed back, right? So there's more scrutiny in that area now. The CRA is
run afoul of the CRA, I guess.
Well, yeah, I mean, we have to be, sort of keeping up on what they're looking for at all times, right? Like 10, 15 years ago, you could get away with, allocating capital gains exemptions to minor children, adult children, parents, and the cash would often just cycle back to mom or dad, business owner, and nobody would really bat an eye. But that's changed, right? And we've got to be very careful now that we're sort of doing it according to the rules.
Well,
right?
let me ask you about this, because I think it's really interesting. During exit planning, of course, there's the initial phase, which is figuring out the owner's strategic pathway, and then figuring out whether there's a gap, between what the business is worth now and what he needs it to be worth, and all that. So often business owners, their first thought is, I'm just going to sell the business, just put a sign like they were a real estate stake on their property, and people are going to come out and buy. Well, we know that's not how it goes. And only a small percentage of businesses that actually get listed close. But so owners are looking at the idea of, could I transfer it to my employees or my management team? Could they carry on the business? Can I still keep a stake in the business, so as it grows, I'll benefit from that? All these things are on internal transfers, but they're worried about funding, and they're worried about, if children or key employees. How do you deal with those kinds of challenges or those kinds of opportunities?
Yeah, for internal transfers, it's a great question. I mean, certainly if you're selling your business to a third party on the open market, often you get a fair bit of cash up front, and it's a little bit more straightforward from that standpoint. Sometimes with internal transfers, whether it's to family members because they're active in the business, or if not, key management personnel that have been with you for years that you want to take care of and include. And yeah, I mean, it really depends on the owner's goals and objectives as far as their retirement, and how much money they need and when they need it, right? I mean, when we talk to owners about these internal transfers, it's cash up front versus cash over time? Are you gonna require, these purchasers, let's say it's key management, are they gonna buy your shares directly such that they arrange their own financing and have to
Right.
sort of deal with their own debt servicing costs? Or is your buyout ultimately going to be funded by the company itself, right? And can the company sort of, depending on how we structure it, will the company pay you out over time, right? And
Does the company have the cash flow to?
does the company have the cash flow, right? And again, it's that, but it's also the tax result to the business owner, because if the business owner sells his or her shares, whether it's to family members or to key employees,
Right.
they can get capital gains treatment and potentially the capital gains exemption. If the company is ultimately going to fund the buyout because family members or management don't have the means to secure their own financing, then
Right.
sometimes the tax result is not a capital gain, it's a dividend, right? And different outcome, right? So it's really just, discussing these options up front with the business owner, trying to understand what's palatable to them,
Right.
and guiding them to the right decision, right? And,
Right.
and
Yeah.
what conversations have been had with the family, or what conversations have been had with the management employees, and
Right.
they understand how this all works. It's trying to be transparent and, and deal with both sides of it in terms of what they're walking into.
Yeah, I know. And you and I are working with the client collaboratively exactly that. It's interesting because I guess, how do you advise to structure something like this? Well, maybe the management doesn't have a lot of money, but they have some money, they have some skin in the game, and the owner doesn't want to fund the whole thing because that's not going to help them, help him get onto his goals. How do you help? How do you advise on that?
Well, I mean, what you're describing is almost less of a tax issue at the end of the day, and more of a, a practical sort of business issue in terms of what both sides can handle and are expecting, right? I mean, certainly there's tax implications to whatever outcome we arrive at. But yeah, it's understanding, how much can be paid up front, because, a business owner that, say sells his or her shares, can only sort of take a reserve on unpaid proceeds up to 5 years under existing tax rules if it's a direct sale to family or to management, right? So you can only defer, reporting capital gains and paying the tax, assuming we're talking about something over and above the lifetime capital gains exemption, up to 5 years. So there's managing that, and then there's managing ultimately what those employees or family can afford if they're going to fund it personally, right?
Yeah.
There's a new measure that came out. It was first introduced in the 2023 federal budget,
Hmm.
and it's sort of been further clarified in recent months. A concept
Yeah.
called employee ownership trusts, and I don't
Right.
know if anyone on this call has heard of those trusts yet, but we're still trying to get our heads around it as a firm at PwC, as far as, what situation an employee ownership trust could work the best in. And essentially what these trusts are is it's an opportunity for, the owner of a business to sell his company or his shares to his employees or to his management team. And but he wouldn't sell it to them directly. Like the management team or the employee group more likely would create a trust, called an employee ownership trust, and that trust would become the new shareholder of the company. So the owner would sell his or her shares to the trust, and the way that the rules have been drafted in this circumstance, at least from a tax perspective, is it's quite advantageous to the owner. The 1.25 lifetime capital gains exemption is increased to $10 million for an owner who sells his or her shares to a qualifying employee ownership trust, or EOT as we call them.
Right.
So you get an immediate tax benefit if you sell your business for up to $10 million. You can't share the gains exemption in this circumstance. With family members, I think it's kind of limited to the owner himself, that $10 million. But nonetheless, I mean that's a big jump, right?
Right.
Plus, as an owner, you can defer the proceeds in terms of, if there's something over and above 10 million,
Yeah.
I think it's a 10-year deferral as opposed to a 5-year deferral as far as recognizing the capital gain from that sale, so that you can spread it out longer if you don't
Spread out longer.
in front. And the trust itself has a 15-year sort of period where it can borrow money from the company to pay off the owner,
Right.
and not have any adverse tax implications to owing the company. Whereas in normal rules, if a shareholder borrows money, it has to be repaid by, within 2 years to avoid adverse tax implications.
I see.
So they've set up some pretty preferential sort of tax ramifications if you can qualify and set up an employee ownership trust. There's a whole host of sort of legalities to these trusts that have to be met, of course. And
Yeah, I'm wondering what kind of how would you describe the business avatar that would fit this?
yeah, I mean, it sounds like, a business where, there's, call it, I don't know, anywhere from 20 to 60 employees. It seems to be the sweet spot where, legally they would all be added as beneficiaries of this trust, while they're employed. And, there seems to be a mechanism where, assuming the business is profitable, over and above what it needs to use to pay off the owner, of course, such that, the participating employee beneficiaries would receive, profit sharing, annually from the business through
Yeah.
the trust.
They're putting no money in,
They're putting
zero,
no money in. They're just sort of legally added.
100% financed.
Yeah, I mean, what's a little less clear, and again, what we're trying to get our heads around is, when an employee sort of resigns from the company, what, if anything, are they entitled to from a trust capital perspective? I mean, is it only an interest while they're employed? From a profit sharing standpoint, whatever equity is sort of building up in that trust, who ultimately benefits from that growth, right?
Well, that market, or you described that size of business you described, that's a huge
It
number of
is.
businesses.
It is, right? So, we're just learning, as we go here, whether these trusts are going to be popular, whether
Yeah.
they're gonna be practical. We know the tax incentives make sense. It's just whether some of these legal, details and practicalities are going to work for business owners and ultimately their management and employee teams.
So there's a lot you can do before the event, for that day, that exit day, and you need to do that well in advance. Minimum 2 years, 3 years. I mean, everything you described today, I think, oh, that's going to be some work.
Yeah, like for example, like if an owner comes to us and they're the only shareholder, right? And it's like, oh man, I'm learning about this capital gains exemption. I'd really like to have my spouse or partner, and I'd like to have, maybe some children included so that we can all share in this opportunity, right? We need time, right? Like we need to do a reorganization. It's called an estate freeze. We need to bring in those other family members either directly or through a family trust, and we need at least 2 years to of lead time, not only to satisfy the test of ownership, but to ensure that enough value can attribute to that trust so that the additional family members can ultimately receive sufficient value to use their capital gains exemption, right? So, I always say if we know that an exit is coming 5 years down the road, I mean, that's ideal from that perspective, right? Not so much because we have to satisfy CRA tests, which sometimes in 2 years, but so that enough value can actually attribute to that new shareholder, right? Or those.
And the business may need to grow.
That's right. Exactly.
Maybe
right?
it's not there yet. So that's the next phase, really, in terms of just maximizing valuation, because the topic for this conversation was about putting more money in your pocket. It's like not what you get for your business. Like it's not what I sold it for $10 million. What actually ends up in your pocket is ultimately what what's most
Yeah, I
important.
mean, the tax man, you can't avoid him or her for tax person. You can't avoid them forever, right? It's just trying to see what opportunities are out there, whether it's absolute savings, whether it's deferral. Um, but yeah, it's
So how much saving, like for just kind of thinking through from the business owner
yeah,
standpoint, thinking how much that sounds like it's going to cost a lot of money. Like how much do all this advisory work that needs to be done on the business end up costing?
well, it's a good question. I mean, we as tax advisors, as a public practice firm, we charge based on our time, right? So, I mean, what we're doing for business owners is we usually get engaged, especially if it's a client we don't know or we're getting brought into this process. I mean, we get engaged to do a phase one where we ask a lot of questions, and sometimes it's a few meetings before we get to the bottom of everything. And we
Yeah.
just sort of bill based on our time to ask questions and gather perspectives. And then once we have a better idea of what structuring or changes may be useful, then we can estimate how much time it'll spend to implement those transactions, um, and quote accordingly, right? But
Yeah.
sometimes it can be a significant investment, but usually we lay that out as far as if we spend so much with PwC, and often you're going to need a law firm to paper all the work. Um, what is that total cost going to be compared to the potential tax savings when the exit happens?
Well, that's got to be the question, because ultimately, if all this isn't worth doing, then why invest in it, right? So there's a return on an
Yeah.
investment
So
because
we're very transparent about
yeah,
what that looks like, and we want to make sure that the owners kind of know what they're paying for, why they're paying for it, and just really keep the transparency high.
potential gain is, right? So either in tax savings, and so
Yeah.
that's really where your area, especially you, because ultimately, if less tax goes, less of those proceeds go to CRA, go to the owner, then
Yeah.
you've done well by them.
Yeah, and we often will model out, if you sell your shares, and once we know how many shareholders there potentially could be that we have access to, say within
Right.
the family, we model out a share sale, and then what the estimated tax will be. If it inevitably is an asset sale, and you're going to be dealing with a purchaser who's likely going to buy your assets, again, it's a different model. We calculate the relevant corporate taxes that are going to be, that are going to come up on that transaction, and then ultimately understand, okay, well, what is your plan for those proceeds, right? Like if you sell your assets, your company is going to have this influx of liquidity. All of a sudden you're going to have to
Right.
deal with some initial corporate tax, and then, what's the plan? Are you going to reinvest those proceeds at
Right.
the corporate level into some other asset? Are you going to make distributions for personal use? In which case we need to model that out as far as how we can get the money out of the corporation to the family in a tax efficient way.
Right.
Given,
And then financial planning, estate planning, and all that.
yeah, of course, all that sort of fits together again, kind of when we have a bit more clarity as to the type of deal, and then the post closing plans, as you say, right? Because if it's a retirement, I mean, what does retirement look like, right? Is it going to be a real retirement, or are they gonna get involved into some new business venture or wealth
Yeah.
creation
Yeah.
opportunity?
So I mean, this goes back to the initial discussion around, that this takes a group of expert advisors focusing. So if you guys are focusing on one area, you've got a financial wealth planner, estate planner, we're focusing, all these people are focusing on the owner's goals and objectives, and everybody has a role that they bring and value that they add to the process. Ryan has a question.
Yeah.
Ryan says, on these employer ownership trusts, do you know whether all the owner's shares need to be sold to the trust, or can they sell only a portion of the shares? I think it's 40,
That's a good question. I
51%,
think
right?
from my recollection, again, we're kind of learning on the fly, Ryan, but it seems like as long as the majority of the shares are sold,
Yeah.
we should be good. Yeah, controlling interest.
Controlling interest. So yeah, exactly. So it's what it is. It's 51%. So
Yeah,
I
that's
guess,
in
which
order
means that the owner
to
can still retain,
some of
49% of that business. He
Yeah.
could sell some of it to his managers and get money out of that. He could bring in another investor or someone on the board, all that sort of stuff. Yeah, so there's some opportunities there, of course.
Really, just to elaborate for one sec, I
Yeah.
mean, Ryan, these trusts are creating a lot of buzz in the business and tax community. The tax incentives are so significant that owners are forced to look at it, right? That's what we're seeing at this point. Again, I really do believe though that some of the legalities associated with how the employees are ultimately treated coming in, coming out still need to be ironed out, and will ultimately sort of determine whether this is going to be something that sticks or not. But there's no question that the tax sort of implications are advantageous, and until we flush this out further, there's going to be continued interest. There's no question.
Right. So I just want to, open it a little bit, if we could, to some questions, or just bring more people on board. Is there any other questions that people have, just for Jonathan or myself, about planning or the tax mitigation strategies around this process?
There's one other sort of thought I had, Joe, as we're
Yeah.
talking, is maybe people are thinking of a question. One point I wanted to make is we see, of course, we deal with a lot of share sales, as I suggested, because vendors get the best tax result. Our deals colleagues at PwC that we work with a lot, working through these transactions, a lot of the times, earnout provisions are sort of built into these deals just so that purchasers can have some sort of certainty that the business, of course, is going to continue to be successful. Sometimes the owner sticks around for a while and make sure that relationships are transitioned or whatnot.
So when you say earnout, just so everybody understands, what do you mean by
Well,
that?
earnout is, based on certain sort of milestones or benchmarks being achieved by the company, and over the next year to
Right.
4 years or 5 years sometimes, additional sales proceeds will ultimately be payable to the exiting owner, assuming that those milestones can be reached, right? And it's something that is not always understood in the tax community in terms of how those earnout proceeds are ultimately taxed. So it is important that whatever tax advisor is involved, that they're taking note if there is an earnout provision in the deal when it's a share sale. It's different when it's an asset sale, but especially when it's a share sale, because you want to make sure that those earnout proceeds, when they're received in a subsequent year, assuming those benchmarks are met, are actually taxed as capital gains and not taxed as straight income.
Okay.
Even with the increase in the capital gains inclusion rate last month, it's still better than 100%, which would be income. So, sometimes a special election needs to be filed with the owner's return in the year of sale, just sort of establishing that any subsequent earnout proceeds can be taxed as capital, because just the way the Income Tax Act is worded, earnout proceeds are actually income. They're contingent receipts, and therefore straight income unless you file an election. So the election is very tried and tested. The CRA accepts it. It's just something that's easily forgotten, and we deal with this a lot. So
a lot. You deal with that a lot.
Well, there's earnout proceeds all over the place.
Yeah. So in other words, the company is saying, yeah, you will pay you the rest of this money here, but you've said the business is growing at this. You're making these predictions about the business, and so we want you to give us some assurance that we'll meet those targets while you're here. Otherwise, you're not going to get a significant part of what might be your sale.
Yeah, I mean,
price.
and we just want to make sure that if they earn what's rightfully theirs in a few years, because the business has sort of held its own, that the tax implications are optimized.
And that's about filing something on time.
Yeah, that has to be filed in the year of sale.
In the year of sale, yeah.
So that it sets you up for those subsequent earnout proceeds to come in the future. If you forget the dedeadline, you're kind of out of luck. So
yeah. So this is what you keep track of. You know what the rules of the game are, and that's how you play better. Okay, so I didn't see any more questions here, but I thought maybe we would just, I don't know how you're feeling, Jonathan. Any closing thoughts or remarks you'd like to make?
Yeah, again, I mean, I think I've been very clear at trying to get tax advice as early as possible in this process.
Right.
Whether you need to move assets out of the company, to keep flexibility, whether you need to insert new family members, whether you need to make sure that the exact structuring of the sale, sometimes in an advanced way with M&A or M&A group is done, you need lead time for all of those opportunities. And that's all flushed out, of course, in our discovery phase. But if we're
Yeah.
too late to the table, sometimes some of those possibilities are not there.
Okay.
And again, it's, the role of the tax advisor doesn't end when the deal closes. It's not just, there's the earnout piece that I just spoke to, but it's really, whether the owner sells shares and has all of this personal liquidity, whether the owner sells, his or her assets out of the business, and now all of a sudden the company has all of this liquidity, that post-closing structuring, where does the family go from here in terms of their wealth? What are they going to invest in? And then what structure does that need to be, right? And it's just, reminding these business owners that they gotta close the deal, try and achieve tax efficiency on that, but then where do they go after, right? And continuing the relationship with a good tax advisor to keep them organized so that they preserve as much of that wealth as they can going forward, and staying abreast of all the tax changes that are likely still to come, right? Depending on what government we have.
Yeah, exactly. I just wanted to show one more thing here before we go. And I'm not sure if you're seeing my screen now or not.
It's black. You're sharing, but we don't see anything.
Okay, so all right, let me just try that again then. Oh, it's still blank. All right. It's not critical. I guess what I just wanted to reflect back on the whole kind of exit planning as a process and not an event, right? It's
Right.
something that takes place over time, and it goes beyond that date, and forward. I know of a statistic that says that 75% of owners are unhappy or have profound regrets a year after they leave their business. I'm sure there's a number of reasons for that, but it's one of them likely could be that they didn't do sufficient tax planning in advance to ensure that they get more money in their pocket than in CRA's pocket.
Yeah, it's true, Joe. You're right. I mean, it's just the reality of how our system works, right? There's just certain tests take time in order to meet them, and hopefully we have an opportunity to present as many quality options as possible to achieve objectives, right? And it's we work with whatever fact pattern we have, of course, and there's always value we can add, but the most value is early, right?
So he's early.
Yeah. I mean, I met a potential client, a week or two ago, and it's a married couple, and maybe somebody that I talked to you about at some point, Joe, but they're looking at a 5 to 7 year sort of horizon before they think they might exit their business, that I learned in my initial discussion with them, right? So certainly there's there's plenty of time in that situation for us to give them some ideas and start to get them thinking.
Yeah, I don't think that the problem that I find in talking to business owners is, I'm not going to exit for another 5 years. Come talk to me then.
Yeah, well, no, fair enough, right? But at least from a tax perspective, we can start recommending things, because
Right.
we've got other ideas that may help them save tax this year.
Right.
Well, okay, well, that's great. Your structure is great today, but if you're exiting your business, this isn't the best structure. So it's trying to find the balance between, okay, well, what works is best today, versus, your eventual exit, and what's the most important sort of, sometimes there isn't a perfect structure that achieves all objectives, but it's trying to get to the bottom of what's most important and then leading them in the right direction.
Yeah, that's all very good. That's really good. I'm sure there are more thoughts that maybe the attendees might have after they leave the meeting. And might say, "Oh, I wish I would have asked about that." Can we reach out to you?
Yeah, of course. Like maybe you could just, make sure that everybody has my email or phone number.
Sure.
If anybody
Yeah, I'll
wants
do
to pick my brain,
Yeah.
I'm happy to share sort of my thoughts on, anything we've talked about today or anything else that comes to mind, especially as it pertains to this process, right? Because it's a huge life event for a business owner.
Yeah.
Sometimes this is the most tax a business owner will ever pay
Hey.
in a particular year. Often it
Yeah.
is. So
Yeah.
it
And
really
it's
does.
the most significant part of their wealth often. as
Yeah,
well,
yeah,
right? Their
absolutely.
net worth.
right?
Yeah.
And, it's just it's nice to be part
Huge.
of the process as
Yeah.
early as possible so that we can help. Right.
Yeah, I guess that was the greatest takeaway for me is, timing in business is everything, and you got to give this enough time to get everything you want.
Yeah, exactly.
All right. So on that note, I'll just thank you again for taking time out of your busy day, I'm sure, to talk with me and talk with those that have attended. It's been really interesting and appreciate.
Thanks, Joe. I really appreciate it. So thanks everybody for listening. Hopefully you learned something, and yeah, if there's anything I can clarify, please let me know. So.
Awesome. All right. Bye, everybody. Have a great day.
Thanks, you guys.
Thanks, Joe. Thanks,
Thanks so
John.
much.
Thanks, Joe.
Okay. All right.
Thank you.
Great.